Welcome to the Daily Update, Condensed Edition, where I'll go over the action in the market for Friday, June 30th, and then we'll see how things look for Monday, July 3rd. This is a new idea. I've been down with a bug recently, and so on Friday I published what I called a condensed version of the video. I had some positive feedback about that. I can't guarantee that I'll be able to publish a shorter version each day. My real effort and focus is on the long version of the daily video because I believe in having as much information as possible. But there may be days when you just have time to see the condensed video. Other times when you'll be able to watch the longer video. Some of you are also aware that I teach English to Chinese students. I just do that to keep my head in the game teaching-wise. But a lot of times, even after spending 6 to 8 hours on the daily video, it's a photo finish from the time I complete the video until I start teaching. So that's why I can't really guarantee that I'll have a condensed version each day. If I do get positive feedback about this shorter video, then I might post it a little later. It might even be after the market actually opens. So if you're okay with that, let me know. I like giving people a choice. I think the longer version of the video is a lot more important when you're looking to initiate a new position, because to me, if you get in right, the rest will take care of itself. Then you could possibly watch the shorter videos as you're maintaining a position, but I'll leave that up to you. As I did say, I've been a bit under the weather, so please excuse my voice. I will edit out all of the coughing and hacking. So I go right into it from here. Right at the open, we had a gap higher right at the open above R1 at 44.06. We then went up to R2 at 44.15. Prices then kept climbing all the way up above R3 at 44.42. As the day went on, we chopped right around R3 for a while, and then instead of breaking lower, we actually broke higher above R3 and we closed at 44.50. We were up 1.23%, but volume was below average. The technicals are positive, but on the short term, we're looking overbought. Intermediate term, we're a little bit overbought. Longer term, we're still looking okay. The market is really fixated on this inflation and interest rate scenario. A week ago, there were a lot of growth concerns, thinking that globally we're having a real slowdown. Well, the economic reports that came out this past week showed that, okay, we're not too hot, we're not too cold. We're going to think that everything is just fine. We also want to keep an eye on the situation in Russia, which now also includes Belarus, to see if that escalates and has an impact on the market. So, what are some comments? It was the last trading day of the week, month, and quarter on Friday. Economic data, not only for Friday, but for the whole week, was taken as positive. Mega caps were strong, and they've been the real leaders. Apple was able to get above $3 trillion in market cap. There's also growing optimism that we may be able to avoid a recession. The MOVE Index and the VIX are diverging from each other. That's a little bit perplexing to me right now because the MOVE Index hasn't been around as long, so I don't have as much historical data to go back and test how that works. Then on a short-term basis, we have a long list now of overbought conditions. This includes the 20-period exponential moving average, the Williams percent R, the CCI 14 and 20, the stochastics, our standard deviations chart, the Erin indicator, the McClellan oscillator for the S&P, the PMO study, the RSI based on 9 periods, and the boom indicator based on 20 periods. On an intermediate term basis, we're still seeing our oscillators rolling over after really topping out at extreme high levels. We just want to keep an eye on that to see if they end up turning and going back up. We also have the Sean trend meter. And even though this is a long-term indicator, the rate of change going back 200 periods, we're looking a little topsy on a more intermediate term basis. The dollar was down and interest rates were also down, and both of those gave support to stocks. We still have all of our yield curves that remain inverted. We're still extreme positive when it comes to sentiment. We're way over up into the 80 range now, where we had been at 79. Our trend is positive, and the green line has turned back up. We're also crossing back above the moving average, so the ADX is strengthening. They're both above 20. Our bias is positive, and our momentum is positive. The economic reports that came out. This was taken as a Goldilocks report. Not too hot, not too cold. Personal income came in up 0.4% on a month-over-month basis, what they had expected, and a tick up from the last time. Personal spending, it came in up 0.1%, where they had expected it to be up 0.3%, down from the 0.6% that we saw last time. The PCE price index came in as expected, being up 0.1%. Last time it came out at being up 0.4%. The core PCE price index, when you take out food and energy, it came out as expected, being up 0.3%, a little lower than the 0.4% we saw last time. On a year-over-year basis, the price index was up 3.8%. When we got this report a month ago, on an annual basis, we were going up 4.3%. So we are seeing that coming down. On a year-over-year basis for the core PCE price index, we're now showing a 4.6% gain each year instead of the 4.7% that we had been seeing. Consumer sentiment came in at 64.4, a little bit better than the 63.9 that they had expected. When we look at it a year ago, it was at 50, so we are showing some improvement. The Chicago PMI came in up stronger than expected at 41.5, where last time it was at 40.4, but it's still below 50. Above 50 means expanding, below 50 means contracting. Here's the intraday chart showing how we really gapped up above R1, R2, and almost got up to R3 quickly. We danced along this level for quite a while, and then instead of breaking lower, we actually got up higher. R4 was way up here somewhere, and we closed off the high at 44.50. Here's the daily chart showing now that we have a gap going from Thursday to Friday, and we're starting to break above the previous high. This is also positive. The parabolic SAR, we had been seeing the dots on top, which is negative. After Friday, they have now switched to below, so that has changed back to positive. We're also seeing some real strength in transports right now. They were really lagging behind, and that was giving us some concern, but now they're starting to break out from previous highs. We're still seeing the utilities underperform, but they did show some improvement on Friday. Then I'm comparing the S&P on top with the transport to S&P 500 ratio on the bottom. When this ratio is going up, the S&P is doing a lot better. When this ratio is going down, the S&P is doing a lot worse. And we also look at how the transports are improving, but they're still slightly underperforming the Dow. We also want to keep an eye on the NASDAQ. On this 61.8% retracement level, it had acted as overhead resistance before. If we keep going up, will that act as resistance again, or will we be able to break through that? Then we're also watching this previous high on the NASDAQ 100. Can we break through that and keep going? So what's our outlook for Monday? There will be an early closing on Monday at 1 p.m. Eastern Time, and then the market will be closed all day on July 4th. The technicals are positive. They are showing improvement, but we're seeing a lot of overbought conditions in the short term and a few in the intermediate term. We have the IHS Market Manufacturing final reading for the PMI coming out, construction spending, and the big one will be the ISM Manufacturing Index. The geopolitical events, keeping an eye on what's happening in Russia, which now includes Belarus. The markets are still fixated on inflation and interest rates and whatever mood they're in as far as growth concerns. There's no scheduled speeches this week by Fed officials, but that doesn't mean they won't give an interview or write an article or do something that might affect the markets. Here is the economic calendar for the upcoming week, and here are the Stock Traders Almanac statistics for July. I'm not going to go through the top part because I went through that in the longer version of the video. I'm just going to hit the statistics for July 3rd, where we are pretty much positive across the board, and for the month we tend to be more positive than negative. Here's the calendar for July, where we will be in the first trading day of the month. Typically what we see is some initial strength, then we chop around a little bit, and if some weakness starts coming into the market, it'll generally be on a historical basis about the middle of the month. So our scenarios can't really go with the down one right now unless you're totally convinced that we're overbought to the point where we're going to have a short-term pullback, because our technicals are positive right now, so our charts are not confirming that, and they are showing some improvement. So we're going with the up scenario right now, but we are overbought, so that might slow things down or even initiate some kind of a short-term pullback. We can't go with the sideways trend right now because both of our ADX charts are above 20. They're both above their moving averages, and they're both going higher with the green line on top. So our warning signs, the BPIs and some of the other indexes are still diverging. The S&P BPI is looking a lot better. The VIX is still showing that there's a lot of complacency. The VIX is now also starting to act a little weird. That one chart that I pull out sometimes, that shows the ratio between the VIX and the S&P 500, it's starting to go up, and I show that in the longer term video. The cumulative new highs and new lows for the NASDAQ are showing weakness. The 3-month yield is still above where it was at in 2007 before the great financial crisis. Earnings season can be either positive or negative. The positive signs, the parabolic SAR has turned back positive. Our longer term seasonality and setups, which I went through in the long video, they're still in the background. The long-term special K indicator on the daily chart is positive, but on the weekly chart, it's negative. The longer-term equity put-call ratio that we follow is still looking positive. The S&P remains above the downtrend channel upper line. We're far away from that, so I haven't been showing that chart. We're still in a risk-on posture. The transports are improving and may be breaking out. That could be really supportive to the S&P. Lower price levels, not only in the S&P, but on other indexes, may provide support. So far, the support levels that we've been watching have been holding. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, even though they didn't have stellar days on Friday, they continue to hold up, but they have overhead resistance. We had that 61.8% retracement level on the NASDAQ, and we had that previous high on the NASDAQ 100. The Staples to S&P 500 ratio is declining, which often gives support to the S&P. The mid-caps just generated a recent golden cross, and small and mid-cap growth continues to be positive. So our conclusion, the S&P is positive, showing some improvement, but it's becoming overbought. In the short term, we are overbought, yet we are still positive. In the intermediate term, we're positive, showing improvement, and we have a few indicators that are overbought. Long term, we continue to be positive. Thank you. Let me know what you think of this video. And again, if you're getting ready to make some kind of a decision, please watch the longer term video to see if that helps you out more. I hope you have a great weekend, and I'll be preparing the other videos to post over the rest of this weekend.